Mahindra Lifespace in the spotlight, and Amit Kumar Sinha is the MD and CEO now joining in. Thanks so much for taking time out. We want to understand your long-term growth prospects. So let's begin by talking about FY23. That was clearly a breakout year for the company, and you were gearing up for a 5x growth over the next 5 years. So does that mean that now you're expecting a strong upcycle in the real estate sector to sustain at least for the next 5 years?
Yeah, thank you for having me. Absolutely, we are very bullish on the sector. Just to give you a reference point, we are roughly $250 billion market, real estate market in the country today. China, obviously going through its own challenges, is $2 trillion today. And as the population is similar, per capita income is growing, we expect this $250 billion market quadruple in the next 7 years. Obviously, there'll be kings, there'll be ups and downs, but we expect the organic growth to continue. And that gives us enough reasons to continue to better the sector.
So what exactly is driving this confidence? I want to understand from you as to what's working for Mahindra Life.
Yeah, so there are three factors that are going to be critical for us as we think about this journey from where we are today to 5. First is, as we talked about, the market is very healthy. But in the last decade, there's a huge shift from unorganized sector to organized sector. Brands like Mahindra are going to benefit from that. In the past, it used to be 90% unbranded or local builders used to participate in the real estate industry, 90%. Now that's down to 75%, 70%. It's different by cities. So the branded players, the listed players, are taking share away from unorganized sector or less organized sector. That's the biggest tailwind in our favor. The second part that we see is post-COVID, from a customer perspective, the consumer perspective, they want to upgrade from their existing home. They want to have the feeling of Dil Mange More, where they want to have a home which have workspace, sufficient space for families, sometimes nuclear, sometimes larger families. So that behavior is, I would say, organic and will continue to be there for foreseeable future. And the third part is from Mahindra perspective, Mahindra Lifespace has been designated as a growth gem. What that means is Mahindra Group is all behind. From a funding perspective, from a support perspective, talent perspective. So this is a business. If the industry is good, if the shift is happening for branded players, we are able to put the customers. Mahindra Group is going to put a lot of effort behind making sure that we get our fair share of the market. So these three things give us the confidence that we'll be able to take on the market context and get our fair share.
Sure. Amit, the second half is generally a stronger quarter for real estate companies. Throw some light on the demand trends on ground in terms of footfall conversions, how your recent launches also performed, and what do you have in the pipeline going forward?
Yeah, that's a great question. We are really gearing up for our second half, or I think the next 4 months. Given Diwali, festive season, holidays, tends to be a very exciting season. So what we had planned was 9 launches for current financial year. So far in the first 2 quarters, we have seen the impact of launches that we did in the previous financial year. It was more sustenance sales or launch of the new phases of the launches that we did in the previous year. But in the second half, especially in the quarter 4, we have a few new launches planned in Mumbai, in Pune, and Bengaluru, which are the focus geographies for us. These are projects that are going to be quite different from what we have done in the past. As you may know, we have done affordable and mid-premium. And we believe that Mahindra brand promise is linked towards premium projects, taking the inspiration from our auto business. So these 3 projects that we are launching, which are quite interesting, you'll see them in the news in the next few months. You'll see the shift towards premiumization that will attract the customers in line with how the market is shaping up, how the customers are looking for the value proposition, and what we can promise to deliver for customers. So that's what we're also trying innovative things from our side. We had our first ever metaverse-based launch in Pune at the end of October. What that means is you could actually see the exact unit, exact floor, how the balconies are, how the roofs are, and get a much better sense of your own apartment in a virtual, but a very realistic virtual. So those kind of, and this is first of a kind in the country, and we've been told that this may be the first in the world. So those kind of unique ways of getting customers excited about their dream homes is something that we are bringing to the market. That will make our launches even more exciting as they look at various choices they have at their disposal.
I also want to talk about some of the recent developments at the company, because you continued your JV, or rather joint development, of land parcel in Dahisar. What was the rationale behind this decision? Any impact on your launch pipeline that it may have? And of course, the future business development plans too.
Yeah, so just a clarification, Dahisar is something that we got out of recently. It was announced almost 18 months back. There were some CPs, conditions precedent, that were required to be met, but they hadn't happened. So what we have done is we have announced our exit from that opportunity. We are very focused on making sure whatever land opportunity comes to us, we are taking a decision in a shortest and fastest time frame. So the one that we announced recently is in Pune, in Wagholi, which is a partnership with one of the landowners there. And that's something we are very excited about, because we have been able to bring that project to market very soon. But broadly speaking, as the land prices have gone up, we always look for the right partnerships. So while we have the opportunity to buy land outright, we also have multiple opportunities to do joint development with landowners, so it aligns from a win-win economic perspective. And we also forward into society redevelopment, where we don't have to buy land, but we work with the society. And you'll see 2 more launches in the next 6 months. One in Malad Navy colony and one in Santa Cruz, which are part of our society redevelopment.
What would be the split, if you could tell us? How much of a project would be built, developed, where you will buy the land and you will just do it what could be called as complete turnkey development? How much of a total revenue projected will now or could come from the turnkey development, and how much could come from JV development?
Yeah, so great question. This differs by cities. I would say in Pune and Bengaluru, 80% of our development, or GDV as we call it, would be based on outright purchases, and 20% would be, let's say, partnerships. Whereas in Bombay, that ratio would be, let's say, 50% outright land purchases, and 50% and maybe more on the joint development as well as society.
Okay. Most of the debt company or real estate companies are saying that we will go easy on a debt. We spoke to the management of Lodha. They are looking at net gearing of less than 1. DLF technically is almost net debt free if I take the reserve out. What would be your plan? Because with Mahindra Group advantage, you have no problems in raising debt. When others are contracting, you can expand. So what is the strategy you're likely to follow?
Yeah, so I think we are very careful about the real estate cycle. And the most of the challenge that we've seen in the past, especially in the last decade, is where there was a huge exuberance about the market, and the balance sheet from that perspective was not healthy. So we're very careful about that. Our debt to equity ratio is very healthy. You can say that we're not taking advantage of debt, but we are a very conservative company, conservative group. So we want to abide by the principles. Our cost of debt is 300 basis points cheaper than some of our peers, given Mahindra Group heritage and how we have developed the company from a risk reward. So while we are open to taking debt for our growth, we are going to be very careful about it. Debt to equity ratio of anywhere from 30 to 40% would be acceptable. We are less than 10% today. We want to use that gap that exists in a healthy way and to support our growth aspiration. But that's not something we're going to over leverage for the right reasons.
New cities are you likely to add into your fold in next 12 months?
Can you repeat the question?
How many new cities are you likely to add in your portfolio next 12 months?
No, so we are actually being very careful about depth versus breadth. Our goal is to go deep in cities rather than go broad across multiple cities. So our primary focus from a residential point of view is going to be Mumbai, Pune, and Bangalore. Just for reference, all the organized players combined have 20% market share in these cities, 20%. So it's very small. So there's a huge headroom for growth as we think about branded players taking share away from, let's say, less branded player. We'll focus on going for depth in these three cities. We have projects in a couple of other places. We'll evaluate them like NCR, Gurgaon, and other cities. We will evaluate them in the next 12 to 24 months, whether it makes sense for us to go for breadth if you are able to achieve our aspirational depth in these three primary cities.
Sure. Okay, great to have you on the show. Thank you so much for taking the time out and joining in today.
Thank you for having me. Pleasure.